All right, let's jump right in. Imagine you've spent years building a company from the ground up, and it's finally worth $1 million. Now, what if a single rule change from the government could suddenly cost you hundreds of thousands of dollars when you sell? Today, we're going to break down crystallization. It's a really clever tax strategy that's kind of like an insurance policy for your success, specifically for protecting your lifetime capital gains exemption.
Just so you know, this explainer was put together by Samir Al-Rashani with AI support.
Okay, so here's our game plan for today. First, we're going to talk about that big, scary tax problem that a lot of entrepreneurs face. Then, we'll introduce the solution, crystallization. After that, I'll walk you through a really clear step-by-step example so you can see exactly how it works. We'll weigh the pros and cons, because there are definitely both, and we'll wrap up with a final verdict on what you should do next. All right, let's kick things off with the problem itself. For a lot of successful business owners, this isn't just a theoretical issue. It's a very real, high-stakes scenario. So let's set the stage. You've bootstrapped your company. You put in the weekends, the late nights, all of it was sweat equity. You literally didn't put in a dime of your own money, so for tax purposes, your cost is zero. And now, all that hard work is paid off. Your company has a fair market value of $1 million. Fantastic, right? But here's the kicker, right? The thing that might keep you up at night. Your whole plan for selling the company might depend on using the lifetime capital gains exemption, the LCGE, to save a ton on taxes. But what if the government decides to change the rules? What if they get rid of it or reduce it before you get a chance to sell? Suddenly, all those tax savings could just disappear. And look, we're not talking about small change here. The stakes are huge. If you sell that $1 million company without the exemption, you could be looking at a tax bill of up to $250,000. But with the exemption, that bill could be as low as $50,000. That's a $200,000 swing. I mean, that's what's on the line here. So the big question is, how do you protect yourself from that? How do you make sure a future politician doesn't wipe out your savings? Well, that brings us right to our solution. Section 2, let's introduce crystallization. So what on earth is crystallization? At its core, it's a way to trigger a capital gain on paper today, which lets you use your exemption now while you know it's still on the books. And here's the really clever part. You do all of this without actually selling your company to anyone. You're basically locking in that tax benefit for the future. Okay, so the technical goal here is to jack up your adjusted cost base, or ACB. The easiest way to think about ACB is it's the official cost of your shares for tax purposes. If your cost, your ACB, is zero and you sell for $1 million, you have $1 million gain. What crystallization does is it uses your exemption to raise that cost base way up, which slashes your future taxable gain. Okay, that's the theory. But how does this actually work in the real world? Let's get practical and go back to our founder with that $1 million company to see how this whole thing plays out. You know, the source material had a perfect way of explaining this, and I love it. It says, conceptually, it's like you sell the shares to yourself. Now, legally, that's not what's happening at all. It's a much more complex corporate reorganization. But as a mental shortcut to get your head around it, it's a great fit. So here's the play-by-play, step-by-step. First, your lawyers and accountants set up a corporate reorganization. In this process, you exchange your old shares for a brand new class of shares. Now, here's the critical move. You file an election with the tax authorities to treat that exchange as if you sold the shares for, let's say, $800,000, the amount of your exemption. This creates an $800,000 capital gain on paper. But then you immediately claim your $800,000 exemption against it, and they cancel each other out. The result? You owe zero tax today. Okay, so just to recap where we started. Before this whole process, the cost base, the ACB of your shares, was zero. Every single penny of your company's value was a future taxable gain. And boom, this is the magic of crystallization. After you do this transaction, the cost base of your new shares is no longer zero. It's now $800,000. You've effectively taken that tax-free value and baked it right into the cost of your shares. So what does this all mean for the future? Well, that's the whole point, right? When you finally do sell the company down the road for that $1 million, your taxable gain isn't $1 million anymore. It's the $1 million sale price minus your new, shiny $800,000 cost base. Your taxable gain is just $200,000. You've protected that exemption no matter what happens with the tax laws. Now, this might sound like a complete no-brainer, right? A perfect solution. But like any smart financial move, you've got to look at both sides of the coin. It's not right for everyone, so let's weigh the pros and cons. Okay, let's start with the pros.
The big one, obviously, is that it's an insurance policy against government rule changes. But it also solves another tricky problem, the bad asset issue. See, if your company builds up too much cash or passive investments, it can get disqualified from the exemption. Crystallization lets you use the exemption while the company is still clean. And bonus, you can often do it at the same time as an estate freeze, which saves you a bundle on professional fees. But, and this is a big but, you absolutely have to be aware of the downsides. What if you crystallize and then the business fails? Well, you've just wasted your one-time exemption on something that ended up worthless. It also limits certain other tax deductions you could claim if the business went under. Plus, there's a chance it could trigger something called the alternative minimum tax, and I can't stress this enough, this is complicated stuff. If it's structured improperly, other tax rules can pop up and completely negate the benefit. So, where does that leave us? After looking at all of this, what's the final verdict here? What's the bottom line? Look, the source material could not be clearer on this, and I'm going to quote it directly because it's that important. Professional tax advice is needed. Don't try this at home. This is a sophisticated tax planning tool. It's not a do-it-yourself project for a rainy Saturday. You absolutely need an experienced tax professional to guide you through it. And that really brings us to the final question you should be asking yourself. Your business has grown, it's become more successful, more valuable, that's amazing. But has your tax strategy kept pace? Proactive planning like this is what separates the good business owners from the great ones. For the right person and the right company, crystallization isn't just a gimmick, it's a critical move to protect everything you've worked so hard to build.